The language of trading. You're making amazing progress. You've seen how trades are executed. Now let's see how orders are matched, prices move, and why size matters. Every profession has its special language, and trading is no exception. Understanding these terms isn't just about sounding knowledgeable. It's about making better decisions and communicating effectively in the market. Let's start with two fundamental positions you can take in the market. When you think a stock price will rise, you go long. When you think it will fall, you go short. Going long is straightforward. You buy at a lower price and aim to sell at a higher price. For example, buying a stock at $10 with the goal of selling it at $20 for a profit. Going short is more interesting. You borrow shares from your broker, sell them at the current price, and hope to buy them back later at a lower price before returning them. Remember our order book from the last lesson? Short selling adds another dimension to it. When you short sell, you're selling first and buying later, the reverse of a long position. Quick task. Short selling steps. Short selling follows a structured process. Order the steps into the correct sequence. Now let's meet two important characters in the market: bulls and bears. Bulls believe prices will rise, while bears expect them to fall. Here's an easy way to remember. Bulls thrust their horns upward when they attack, while bears swipe their paws downward. When the market is rising overall, we call it a bull market. When it's falling, it's a bear market. Knowledge check. Spot the market trend. Drag each statement to the correct category. A limit order lets you specify the exact price you're willing to accept. Want to buy a stock, but only if it falls to $40? Place a limit buy order at $40, and it will only be executed if the price reaches your target. Stop orders activate when a specified price is reached, and then they become either a market order or a limit order. A stop market order executes at the next available price once triggered. A stop limit order gives you price control, but there's a chance it won't fill if the market moves past your limit. For example, if a stock is at $50 and you place a buy stop at $55, your order activates only when the price rises to $55, useful for breakout strategies. A stop loss is a common way traders use stop market orders to manage risk. If you buy a stock at $50 and set a stop loss at $45, your position will automatically sell if the price drops to $45, limiting your loss to about $5 per share. In fast-moving markets, though, the actual price you get may be slightly worse because the market can move quickly between the time the order is triggered and when it gets filled. This is called slippage. These order types are your tools for executing precise trading strategies: market orders for immediate execution, limit orders for price control, stop orders for breakouts, stop losses for risk management. Time for a quick quiz. Let's say you believe a stock priced at $75 might drop initially but then surge higher. You want to buy only after it falls to $70, but also protect yourself if it keeps falling. Which combination of orders works best for this scenario? A limit buy order at $70 and a stop loss order below your entry point. A stop buy order at $70 and a limit sell order. A market buy order now and a stop order at $70. A short position now and a buy limit order at $70. Yes, you're right. Perfect. A limit buy order at $70 ensures you only buy if the price falls to your target. Then, a stop-loss order protects your position if the price continues to fall after your entry instead of rebounding as you expect. Let's recap what we've learned. Long positions profit from rising prices, while short positions profit from falling prices. Bulls expect prices to rise, and bears expect them to fall. And the 4 key order types, market, limit, stop, and stop loss, give you control over your entries and exits. The players in the market. Trades don't happen in a vacuum. Behind every price move, there's someone hitting buy or sell. In this lesson, you'll discover who's trading, why they're doing it, and how their actions move prices. Let's meet the people behind the trades. We step into a bustling global trading marketplace. The trading world is like a vibrant marketplace with different types of participants. Some are here to buy groceries, others to sell goods, and some make sure everything runs smoothly. Here we see retail traders, individuals like you and me, trading with our own money. Some are beginners, others are experienced, but they all make their own decisions using trading platforms. See that? The retail traders are using the order types we learned about in our last lesson, limit orders, stop losses, and more, but they're using smaller amounts than those big players over there. Let's move to this impressive building. Inside are institutional traders, big hedge funds, banks, and investment firms managing billions of dollars. They use advanced data and high-speed trading systems. Institutional traders often break large orders into smaller pieces. Remember how we learned about walking the book in our order book lesson? This helps them avoid moving prices too much against themselves. Now, those traders over there are doing something special. They're market makers. These firms act as financial intermediaries by constantly quoting both buy, bid, and sell, ask prices. This ensures there's always someone to trade with, making markets more liquid and efficient. Time for a quick quiz. Let's test your understanding. A trader places large orders, but breaks them into smaller pieces to avoid moving the market too much. They manage money for pension funds and wealthy clients. Which type of market participant is this most likely to be? A central bank.
Yes, you're right.
Correct. Institutional traders manage large sums of money for others and typically break up their orders to minimize market impact, just as we saw in our lesson on how trading works. We now move to another section of the marketplace. Let's look at why different market participants trade. There are different reasons and motivations that shape how each approaches the market. These traders are speculators. They're trying to profit from price movements. Using strategies based on technical analysis, news, or market sentiment, they buy low and sell high, or short sell and buy back lower. Over here are hedgers. Unlike speculators, hedgers use the market to reduce risk, not to chase profits. They take positions that move in the opposite direction of the risk their business faces. So if the market moves against them, their trade helps cover the loss. And finally, meet the arbitrage traders. They spot tiny price differences for the same financial asset in different markets and exploit these inefficiencies. If gold is cheaper in London than in New York, they buy in London and sell in New York, for example. Each of these traders uses the same order types and market mechanics we've learned about, but with different goals. Speculators seek to profit from price movement, hedgers protect against risks, and arbitrageurs exploit inefficiencies. Time for a quick quiz. An airline purchases oil futures contracts whenever it needs to secure fuel prices for the next several months. Their goal isn't to profit from oil price movements, but to maintain stable costs. What type of trading activity is the airline engaged in? Hedging.
Yes, you're right.
Exactly right. The airline is hedging, using the markets to reduce their exposure to the risk of rising fuel prices. This helps them maintain predictable costs even when market prices fluctuate. Understanding these different market participants helps explain price movements. When institutional traders move large positions, they create waves. When market makers pull back, spreads widen. When hedgers rush in, certain assets may rise or fall based on underlying risks. Let's recap. There are several types of traders. Retail traders are individuals who trade with their own money. Institutional traders are large firms that manage money for clients. And market makers provide liquidity by always offering both buy and sell prices. Now, why do people trade? Some trade for speculation, hoping to profit from price movements. Others trade for hedging to reduce risk in their business operations. And some engage in arbitrage, taking advantage of price differences across markets. You've learned about the key players in the market and why they trade. Understanding these players and their motivations helps you navigate the market landscape. Now let's see how well you understand trading mechanics.